Kay, with your, I guess lately they've been weekly webinars. I guess we had envisioned that when we started in this, we could have weekly or twice weekly or every other week, I guess, as we saw fit. But I guess we're trying to maintain at least one a week. The danger of talking too much, though, is that we just fill your head with all kinds of useless ideas that don't help you make money. But in any case, or make you become too short-term. But in any case, here we are again. Dr. K, you're there, I trust.
Yeah, I'm here.
Anyways, I got my screen up here, and I'm sure some of you are going to wonder why Netflix is at the top, and that's because I'm short the stock, and I have been for a while. It's been, as I tell Dr. K, it's my security blankie short, and it keeps going down. Unfortunately, as of today, it became more than a security blankie short, and I'm not even going to tell you how short I am this thing because you'll think I'm absolutely off my rocker. But we got a decent trailing stop on it, so we're good. And we'll see how it works. But I think Netflix right now is probably dropping, not only because I think their business is pretty much becoming commoditized, and I don't see how they maintain their margins, which they really aren't able to, but I think there's some scare in that people look at Netflix as maybe being the next Green Mountain that's starting to roll over, and, you know, Green Mountain getting chopped up today big time. In a similar situation, you know, it broke down from Head and Shoulders, tried to rally back up, and then rolls over again and breaks down completely. So now what you have Netflix doing is it's kind of in this position here, if you wanted to compare the two. So, you know, I shorted it. I didn't put it out as a short sale setup because it's a little bit tricky here, and I don't really want other people messing around this trade because I'm going to play this real heavy. So it's mine, mine, mine. So far it's working. If it was losing money, I probably wouldn't be telling you about it. Anyways, let's look at the market here. Where are we? Where are we? Dr. K, we are on a buy signal, yes?
That would be right.
That would be correct. And, you know, market broke down, gaps down. I thought you might get to 2,900 on the NASDAQ, but you get back above the 50-day. You know, it's classic QE type stuff. But you constructive action along the 50-day moving average. You come back up. The volume's picking up a little bit. You're starting to see better buying interest. You see how there's really no bid coming down. You don't see a lot of volume coming in, no buyers stepping in. Now you're starting to see some buyers. I don't know if that's the impetus given to some money managers who maybe are underinvested right now and they have to use a pullback to come in, so they see this move and they got to come in. But net, you're seeing volume pick up here along the 50-day, which you could say is constructive. Right now, you know, it's just holding along the 50-day. So you're on a buy signal, you play it that way. If you're playing the MDM, the market direction model, and that's kind of where you're at now. Otherwise, you've got the S&P. Let's see if I can find the S&P chart. Where are you, S&P chart? You're here somewhere. Well, you were here earlier. Maybe you disappeared. But you had a follow-through day on the S&P last Wednesday. I'll go ahead and pull it up, but it's not going to have the same, let's see, volume because we don't have NYSE volume. But you had a follow-through day. I guess that was last Wednesday here. Is that right? Yeah, it was that day. And you're holding up. To me, that's a marginal follow-through, and I'm not sure what it tells you, but you know, when it starts getting fuzzy with the indexes, the market direction model is able to come up with a buy signal, but from my perspective, I tend to just look at the market as a market of stocks and take it on that basis. And sometimes you can just stop watching the indexes, and instead you can watch Apple trade because that's like an index proxy. You know, market down, Apple's probably down, or Apple up, market's probably up. Anyways, Apple's fluttering around the 50-day moving average. I think this is something to watch because this is my theory. This is the Apple theory, and it has nothing to do with Newton's Apple. If any of you read the article that we posted on MarketWatch about Apple. But it's sitting at the 50-day. The theory is that, you know, you got to buy it at the 50-day. That's support. What I noticed yesterday is it did come to the 50-day and it held. You didn't get anybody selling it through the 50-day moving average, but you also didn't see any big volume support come in. And so, you know, I tested a little bit there. It started to move up, but it kind of gave out this morning, and I unloaded it. I'll let this thing hang out and look for another buy point. But I would not be surprised to see the stock undercut this low in the process of building a base, because I think then you would scare everybody out. And right now, the big story with Apple is it's going to 1,000. Just buy it, hold it, and don't worry about a thing. Okay, I never knew investing was that easy. So, Dr. K, we just load up all our money into Apple stock. What's your take on Apple?
Yeah, I guess Apple's the one exception, right? It's just like Qualcomm was in 19.
It's different this time. It's different this time. Anyways, so And just to give you a little more color on the Netflix, so you can see the thing. This is where I'll get heavy. I come in with this every day, and it's been dribbling down, dribbling down. Now it looks like it's breaking. I'm looking for it to test this low here, and so I'm going to pile on it here. Now notice intraday you're testing the low, so this is kind of a critical area. If it's able to test successfully, I may back off and go back to a core position on the short side. But it's kind of one of these situations is you're not in a bear market, so people will obviously say, well, what are you doing shorting in a bear market? But like I said, I treat the market as a market of stocks, not as a stock market. When you're kind of in this area where, yes, the market direction model is on a buy signal, but I still think you're in this big choppy sideways movement in the indexes, and I think that's probably the key thing here. And you could continue going sideways for a while, and you have some leaders blow apart, and some leaders continue to move higher, and of course you have that going on today. So I'll just run through some stocks that I'm looking at are posted. You can see on my screen here. This is my simple screen. I use one screen, and I got things. These are all the big NASDAQ stocks, and I just break this down into ideas I like, ideas I sort of like, and the stocks I'm just keeping an eye on. And so if we go down Zillow, of course, you had a viable gap up this morning. You had to be on it early and get in there, and it's up higher, despite the market indexes being shaky. Lulu broke out again, and I might use Lulu as an example of what I'm looking for on the long side right now, and I think this is what you guys should all be focusing on, and that is that we already know that we started a bull rally or a market uptrend in January, late December, January, around that time frame, and a lot of stocks broke out at the time. You have Lulu coming out of this big, ugly base, gaps up, and continues higher. For a few times it looked like it was going to break down, but it held the 50-day moving average. It never violated it. You'll notice here the 65-day exponential, the quote magic moving average. It actually bounces right off of it. So I don't know, Dr. K, you're going to have to test the 65-day exponential moving average. I see a lot of stocks going through the 50-day, and they tend to bounce off of that. But I think that's why you have to not only close below the 50-day, but you need to go through the low of that day. So it almost works the same way as a 65-day exponential.
That's what I found in my back tests.
Yeah, from a practical standpoint. So if they go through the 50-day and they kiss the 65-day exponential, that's where you buy the blank out of them. But in any case, this thing breaks out, and this is only a 3-4 week pattern, so it's kind of a flag, and it breaks out. But this is a second stage base, and so I'm looking around for stocks that may be coming out of second stage bases. LinkedIn is one that has yet to come out of its first stage base, because this is a weekly chart, and you can see it's just been building this big ugly base since it came public middle of last year. And so a gap out today might be viable, something to watch for if you want to be brave and buy into earnings. I'm over here flipping a coin, asking myself if I want to take a 10 or 20% position on LinkedIn going to earnings. But we'll have to do an anatomy check on that one first. But I think the bottom line is if it's going to start a move, it'll start probably with a gap up or a breakout from this formation. If that's going to happen, it probably will happen today if it's going to happen. Otherwise, if LinkedIn doesn't come in with great numbers and impress everybody, you could see it sell off. But you've had a lot of accumulation in the stock coming up the right side of the space, which has been relatively steep. The one thing I haven't liked is this sort of loosey-goosey look on this handle, or whatever you want to call it, and it's kind of widening or broadening out. And I don't know, if you took this week out, you might get a couple of railroad tracks, but it's not, it's not like it's been on a big tear. So I just got one eye over here on Netflix, continuing lower. Keep going. So that's what I would watch for today, on LinkedIn. Builders have been very strong. You got Ryland coming out last week, and I noticed one that I bought actually was this FBHS coming out, and it's a little extended now, but big pop through. Did we put that one out as a pocket pivot, Dr. K?
FBHS, I'd have to check just to confirm, since we've been putting out quite a few here.
We did. And sometimes we might discuss them, and sometimes, unless we both feel strongly about it, we won't put it out. Doesn't mean that we might not buy it ourselves if we're feeling in a risky and randy mood. But this one so far has worked out, but it's moved with all the housing stocks. And I know we get a lot of questions about those, but something about housing stocks.
We haven't put anything out on it.
Okay, so it kind of blew that one, but that's okay. We'll get the next one. But I would watch that one for a pullback, because I think this is a pretty strong story. It's a spin-off from Fortune Brands. It's coming in. Maybe it pulls back into 22 if the market comes off and the uptrend holds. So, but you're seeing housing turn around. So the question becomes, should I be playing housing stocks? I don't know. It's hard to say whether the group has turned. Dr. Hay, do you have any take in terms of spewing, verbiage about what you think about the housing sector?
Well, see, that's the problem is that the sector, there's a couple stocks in the group that are doing well, and a lot of stocks in the group aren't, but the group rank is quite high. And that said, this sector has been really slow to get going, and with something like FBHS, that too was pretty slow to get going. I mean, if you look at the pattern prior to a few, just the pattern since the IPO, it really hasn't taken off. It's a very slow mover, and a lot of these housing stocks tend to be that way. So it wasn't very exciting a few days ago when it, had that good earnings report and, came up off the 50-day into new highs. To me, it wasn't, it's not a power mover stock, and I think, it's had a nice move in the last 5 days, but I don't think it's going to continue on that level of momentum. I think it's going to settle in again into this, stair-stepping slow pattern.
Right, and that's why I take that nice move and put that one in the bank, as far as I'm concerned.
Right.
I'm going to ask some quick questions since we're still more or less in the general market. Dr. K, someone says here, if I'm out of pocket for a day, would it be prudent to close out my position in the TVIX model or just set a stop loss?
Say the beginning again? If you're out of a what?
I'm out of pocket for a day. I think they put a position on the TVIX and they're losing money on it. So that would have been short the TVIX? Is that right?
Right. You would be short the TVIX on the day that the model went to a sell on the TVIX or UVXY. You would have been up probably 5 or 6%, and then yesterday I think you would have been down about 1.5% or something like that, and then today you should be up again if you're short the position. So if you're out of pocket, that tells me that you probably bought or rather shorted late on the day of the signal, on the day of the sell signal. Now, when you short late or you buy late, know that however much percentage you're off is that much risk added to your trade. So if these things whip around all over the place, and if you're going to buy late, you're adding that much more risk to already a very risky position. And we stress that on the site that these things can whip around 50% in a day. 40% in a day, during volatile markets. This market isn't one of those types of situations, but if the market gets very volatile quickly, like it did in August of 2011, these things can be all over the map. And the model is designed to contain those moves simply by virtue of position sizing very, very lightly and knowing that with the volatility, with downside volatility, in other words, with big risk, in a volatile market, you also have big reward. So if you can stay with your trades and stay with the whipping around action in your trades, then back tests in the model have shown that you will come out ahead in the long run. So that's key. That means really position size so that if you're a 10% position in your account and say you're down 40% on that position, that means it's costing your account 4%. Is that something you can live without flipping out of the position prematurely?
Okay. Actually, I'm long the UVXY. I should let everyone know. I think you're undercutting this low, so I think you're susceptible to a rally here. Sorry, Dr. K. That's just the way I'm playing it. But I've got my own little system for trading this, and I've been trading it over the past few weeks, and it's actually done okay. So, but it's short term. I'm not trying to play a trend move on it. I guess your theory is that you might have, for instance, you may have some moves up and down that are tradable, but you're saying longer term, if the market remains as it is, the VIX will continue to erode. Is that your point on this trade?
Right. There's a tendency toward these leveraged ETFs to degrade. In other words, if you're short a position, your odds are that you're going to come out profitable, and then there are only the exceptions when the market really starts to sell off hard. Then you can become unprofitable very quickly. Of course, the model is designed to take you out of the position and actually go along the TVIX or UVXY in such a situation, so then you can reap the benefits on the long side as the market plunges lower and these instruments spike higher. That's the ideal situation. That's what the model strives to do. And over the testing period, which goes back to the beginning of 2009, so we're talking about almost 3.5 years. That's the general rhythm of this model. Is that it tends to the short signals tend to last longer because markets tend to trend in a longer pattern, then they tend to sell off. When markets sell off, they tend to sell off very quickly, especially in this age of QE.
All right. So you can see we have a little bit of a bet on this going right now. And I think it also shows that we don't necessarily always agree on everything all the time at one point in time. Right, Dr. K?
Right, and everyone's got different time frames. And I know there's some members that do trade or have been trading the TVIX or the what is it, the XIV, you know, these different VIX instruments, and they have if they found a way that works for their time frame and risk tolerance, and you know, my guess is that from what I understand, they're trading very short-term time frames, sometimes intraday, and we don't do that. And the model isn't designed to do intraday, but it is designed to catch brief swings, and especially on a buy signal. The buy signals tend to last very short periods, just simply because when the market sells off, it usually does so fairly rapidly, as opposed to 1981 to 82, where you had this long, drawn-out recessionary bear market. We're not in that situation. We're in a QE environment. So if you look at 2009 till present, we've only had 2 sharp sell-offs of great magnitude. All the other sell-offs were also quick, but they were of much smaller magnitude, typically within several percent or less on the NASDAQ composite.
Anyways, yeah, so I think this is UVXY is a great vehicle for short-term trading, almost day trading if you can, because you get 6-7% moves one way and then the other, and if you play them right, and you play them in size at the right point, you cut your losses very quickly, you actually can make a lot of money very fast. So I suppose it could work either way. And let's see, I'm going to go through some questions. Actually, let me just run through what you're seeing up on my screen here. Spelunk, this is, that looks a little funky there. Let's see if I can spread it out. But you can see you're just in the IPO flag here, so we're keeping an eye on this one. You know, I think if you want to buy, if you think this is tight and you want to buy in here, I think it's risky. I tried doing that. I backed off. So we're kind of hanging loose and seeing if you get some sort of a pocket pivot in this thing at some point. But I'm guessing now is not the time. But it's a very compelling story. They're the Google of the business world and basically help businesses search for and actually manage their data. And there is this sort of what they call machine data explosion going on, where there's so much data being produced across the internet, across the cloud, you know, from social networking, from e-commerce and so on, that companies really are finding themselves hard-pressed to keep track of all this data and make it useful. And they were talking about how Splunk was even used by the Japanese government after the earthquake to keep track of various emergency operations that were going on. So it's very interesting. They're losing money. I think it's something to keep an eye on here. Nice tight base here. Citrix had a Bible gap up last week. I don't know if we talked about it, but it's basically trying to flag. What I think is interesting here is if you look at Citrix, it's trying to come out of a couplet handle base on the weekly chart. So this may be viable. So this Equix, we know we had a Bible gap up. What I don't really like here, and I tried buying this off of here, it's not really holding, is you have the gap and then you drift in. My thing is, if you know, it's tempting to buy that kind of drift in, and a lot of times they do turn around and go higher, but I think that's a function of the market. If the market weakens, they're going to break down. But I like this better, and this is tough to buy now because it's way up there, but you might keep an eye on it. You know, we had a Bible gap up here. It never, ever violated that. And continue to trend higher in choppy fashion like the market, but you get this other Bible gap. Now you have 2 in the pattern, and so you know, this, to me, I don't think it's going to lead to a big move just yet. It may need to go sideways, and I think the same thing goes with this GNC. You know, you have one gap up here, one gap up here, and then another gap up, and you're kind of getting to the point where 3 gap ups in a couple, 3 months, and it's getting a little bit long in the tooth here and pretty obvious. So that's how I look at these gap ups. Yuri, we've liked, but you know, it's gapping up, going nowhere. STX, nice support off of here on the pullback to the top of the base, but I think this thing's going to settle down and has to spend some time going sideways. This is a bummer. A Bible gap up that reverses. You know, I don't know if that tells you anything about the market, but in a lot of ways, you see action after earnings that will freaking give you a headache. And I can tell you things like, you know, MasterCard yesterday sells off after earnings and it closes in the upper half, and now today we're rolling over again. But that's because V is rolling over again, or you know, like it did a week ago or so, and it's doing that again and taking MasterCard with it. So, you know, that kind of sucks, and VRX gets removed from my screen. So not that I bought any. Solar Winds, you get the Bible gap up, and that's very strong, but looking for it to pull in if you're going to try and buy it. Tractor Supply, I didn't like the fact that you're not really getting any big volume coming out of here. This thing's doing well, though. You can't really fault it. I don't know how you pronounce this. Dr. You know how to pronounce this one? Interxion?
Interxion. I think it's Interxion, but I mean, whatever.
I don't know. It looks like an NV. Is that a Netherlander stock? Anyways, this one's acting kind of interesting, but it's way up there. So another one that's just on my watch list. Let's see. We're watching InventSense. Is this a pocket pivot? Hey, Dr. K, is that a pocket pivot? And if it is, should I be buying it?
Well, it's straight up off the bottom there. It's the pattern is very volatile, choppy. It's a lower grade pattern. The story behind the company is very exciting, but the technicals really rule the day here. So I would avoid this for now and wait for it to really set up properly. Wait for the price volume to settle down before buying.
Yeah, and this was actually one position we got hit on pretty good. Just to let you guys know, not everything's hunky-dory for us all the time, because we were getting very aggressive and averaging up, and then this thing just blew apart in a matter of 4 days, and you can take a pretty good hit on that because of that kind of a raking. But if you guys recall, I've been talking about this as starting to set up as a short sale or a head and shoulders, and I told you guys you can go back, I don't know, a couple of videos and take a look. But I do know I told you guys I'd look. Here's your neckline here. You got your left shoulder, your head. And now look for a rally up into the 50-day moving average. And I think if you go back and look at the videos, I said exactly that. And sometimes that's a playable trade. I don't know how much you like to buy stocks off the bottoms. I don't, so I don't even mess with that. But now it's up here, and I got to wonder if it isn't going to be a short going into earnings today. So I think a lot of this tells you something about the stock. And if it's such a great story, it should have held up better than it did, given the constructive action, the big volume after the secondary. So watch and see how this happens. If you feel real lucky, you might try shorting it into earnings on the basis that if you're at the peak of a right shoulder, it's going to break down. But keep in mind, you could get some funky move that gaps you above 22. Wouldn't surprise me. So anyways, let's go through some questions here. Am I through? Oh, wait, last one here. Tango, Wango Tango. I hate Tango. Great name. Great Ted Nugent song, but Tango is just Tango's around a bit too much for my taste, and you can see this jagged action. I mean, this stock is doing the Tango, wouldn't you say so, Dr. K?
Yeah, in a way that is not a whole lot of fun if you're on the dance floor.
Definitely, and we were on the dance floor, and we sat through this amazingly, and then sold out at the end of the day on this particular day. And of course, it pulls back once, so we're smart, for a couple of days, and then it turns around and goes to new highs. But, to some extent, it's the nature of a thinner stock, which Tango is, and it's the nature of this QE market. And as far as I'm concerned, you're still in this bizarre QE environment. I don't see the economy as really improving. We'll see what happens tomorrow with the jobs number, but people say, oh, what do I do going into the jobs number? I think if you have a good stock and you have a nice cushion on it, there's nothing really to do on the basis of the jobs number. If today you get some heavy-duty distribution on the indexes and we bust the 50-day, say, on the NASDAQ composite, maybe you got some problems, and you might consider backing off a little bit more. But that might be premature. So I think you got to play it on a stock-by-stock basis. And if you have stocks that are acting well, there's not necessarily any reason to run for the hills simply because we have a jobs number tomorrow. Now, if you think about it this way, and I don't even know if this logic is necessarily all that foolproof. We had the ADP number yesterday morning. The market sold off on that. I think we came in with, 117 or 119,000 jobs versus 170,000 expected, something like that. And so it's a disappointment. The futures sold off immediately, but the market held, and then we held up, and so you got this support on the NASDAQ off of the 50-day. The volume isn't here, but yesterday's volume was above average, and you're seeing a little bit of support. The only problem is the day before we had heavier volume than that, and you did kind of stall and reverse. So you're kind of at a point where if we break the 50-day on the NASDAQ, that could be an issue, and it could tell you we're headed for this low, and you're going to head through this low. But one thing I thought is we should get to 2,900 on this correction, and so far the market hasn't wanted to do that. It's issued a buy signal on the market direction model, so you're kind of in this in-betwixt and in-between state, and so I think it does come back to this whole issue of playing the market not as the stock market, but as a market of stocks. And that's why I'm short Netflix and playing some other things.
Yeah, the market seems to have a very flexible ability to absorb bad news. So, bad news out of Europe, I guess, gets redundant after a while. If you look at European markets versus the U.S. markets, there's a striking difference in terms of relative strength. The U.S. market just trudges higher, and again, a QE environment. The Fed, even though they said no QE3, they still are keeping interest rates low by printing money to buy U.S. Treasuries. So, and you've got Euro QE as well through the central banks, ECB and the Bank of England. So I think all those factors are working to keep the markets afloat. So that would explain why when you do see the market come off 5, 6, 7% from its peak, and if you look at the Nasdaq, it's very representative of that since 2009. It looks like all hell is going to break loose, and it doesn't. The market then gets back up on its feet, maybe on low volume. It starts to drift higher in low volume. It makes for a very frustrating environment, but the model takes that into account, this QE environment, which QE has definitely it's rendered a lot of indicators invalid since 2009.
Yeah. So somebody asked, Dr. K, have you done any studies about stocks in IBD's New America section and what the moves they've had after being mentioned in terms of various time frames? I'm not sure why that's really important, but I might just kind of chime in here with an observation that I recall in the 90s, particularly in 1995, a lot of times an IBD article on a new IPO or recent IPO would often be the catalyst for a move in a stock. So a lot of times you'd see, as if the article finally brought something to the surface in terms of investors' awareness, you would see stocks start to do well after they were mentioned in IBD. I don't think it has that much effect. I also don't believe that IBD subscriptions or subscribership is probably much more than 100,000. I don't know for sure, but I'm just guessing based on things that I know from seeing how the paper's operating and the advertising and whatnot. So I'm guessing that you've seen dwindling subscribership there. So my guess is, and I've actually seen this, I think there's less of an effect, but I doubt if Dr. K has done any studies on this, right, Dr. K? Am I right?
No, I never had any interest in spending time correlating that. I mean, the writers, if a story has a compelling edge to it, then it'll make it into the New America section. It's a good section if you want to know all about what that company does, and it gives you a broader understanding of various sectors that you could invest into. So,
yes.
But as far as, when they put out a story on a stock, whether that stock does well or not has a lot to do with the general market, first of all, and second of all, a lot of those, there are a number of these IPOs that don't ever go anywhere because they are IPOs and they carry higher risk. So
Right.
I don't think it's fair really to say, oh, well, the paper overall has underperformed the market in terms of its New America section, because you're not trading stocks in that manner. You're just using New America as a tool to become more aware of what these cutting-edge technologies or services do.
Right. I just want to mention something. I'm just picking this up right now. I've been watching Google because you see these big gap downs and these breaks, and as it rallies up into this area of resistance, I'm looking at it as a potential short. As it's kind of a late stage failure or just a failure. I don't know if this is late stage or what it is, but if you look at the bigger pattern on a weekly chart, it's just got this huge ugly formation here, and it's starting to weaken and break down. Dr. K and I were discussing this the other day, and it could break down, or it could just maintain this big stock status as a juggernaut out there that it really goes nowhere, so it becomes a big, slow, lumbering, go nowhere former leader. But to me, it looks right now technically it's in trouble, and I would be looking for a move down to the 200-day. I think this could be shorted here using the high of today as your stop. And again, not necessarily trying to be bullish or bearish on the market as a whole, but simply taking things on a stock-by-stock basis. And I think that what you're seeing happen in Netflix here, which I'm short, and we've been shorted for another couple of bucks here on the downside, as you've been watching. I think that validates that. You can see the intraday volume picking up on a 5-minute chart. So I like to look at 60-minute charts sometimes when I'm shorting. We talk about using moving averages, and really we only use, for the most part, the 10-day and the 50-day, and then you throw in the 200-day, all simple moving averages, and that's pretty much all we operate with. There are environments, though, where it's more on the short side we're going to talk about, or where we talk about on the short side using 65-day exponential as well as using intraday charts. for timing of shorts, and that's probably the only place I use these sorts of things, but mostly to see where potential areas of support are on a longer time frame. So on a 60-minute, you can see Netflix is just breaking, breaking, breaking. There's no real support in here for a while. So it looks like I'm home free for a little bit. But as I come down to a support area on the 60-minute, I will start to look at cutting back a position, particularly if I'm running a 200 or 300% position short in the stock. Just want to mention that because I know in our new book we talk about moving average, but the new book only covers the long side. We blew off the short side because our intention is to write a new book on the short side, an entire book, somewhere around 150, 200 pages, that I personally intend as a follow-up to the work that I did for the book, How to Make Money Selling Stocks Short, that I wrote with Bill O'Neill. And also adding a lot of the work that Dr. K has come in with on the short side too. And the beauty of us working together on the short side is I have a lot of these ideas and concepts, and Dr. K helps to put a little meat behind him with his studies. And he has shown that stocks that are in the right positions and the right patterns have a very high probability of breaking down and making you a lot of money on the short side. Is that not correct, Dr. K?
There's definitely a statistical relevance all there, as with all these patterns.
So, we're going to have that. So we're actually, there will be nothing on the short side in this new book other than some questions at the back of the book where we took some of our favorite questions from our website and put them in the back of the book. But as soon as we told John Wiley & Sons that that's what we're going to do, they're going to be sending a proposal and a contract over. So looks like our third book is already in the works here, but we're going to take a good 6 months to a year to write that. It took me about a year to write that first short sale book, and I would like to be able to take at least 6 months on this one, this next one on short side. But just so you know, that's really the difference in where we use the moving averages. So, but on the long side, you don't really need too much more than the 10-day and the 50-day. So just wanted to throw that out there. But like I said, my target now on the downside is here, this 60 level roughly. But I think it's the next Green Mountain Coffee. Anyways, let's see, where are we? Let's get some questions in here. So it's got about a half an hour. We already talked about URI, United Rentals. If you buy on a pocket pivot or a buyable gap up and gain 48%, and then the stock falls back, do you hold to your original stop and watch your small win turn into a loss, or do you get the blank out with a small profit and live to fight another day? I say if you get a 48% move, you just take it. Dr. K, what would you do?
With these things, yeah. I mean, if you got profit, quick profit like this, that's generally the rhythm. You want to just bag your profit and move on. Yeah.
When do you give a stock? How much consideration or weight do you give to a stock's SMR rating and ROE? When do you care and when do you not? I ask because Z has SMRC and ROE of 5, yet we got a PPR. My experience with the institutional side of business, and you know that institutions drive the market. A lot of institutions in the 2000s, the whole idea of, you got to have 3, 4, 5 quarters of some earnings growth, blah, blah, blah. Everybody knows that these days. Every institution on the planet knows that XYZ stock has great earnings, and blah, blah. And a lot of them, what they're basing their analysis on and their reasons for buying stocks are really the forward-looking story, because everybody's trying to get an edge these days, and these days everybody knows what the current and recent earnings have been. So I don't think a lot of that is always relevant. In some of the more emerging situations, some of that is evolving. It's often evolving very, very quickly, and I think the smarter institutional investors are on top of these stories, and so a lot of times I might override less than stellar fundamentals because I see very strong price volume action. And you see a stock that's getting big volume, and I don't mean a stock that trades 300,000 shares a day is trading 400,000. I'm talking about a stock trading 1 million or 2 million. You're seeing 4, 5, 6, 7, 8 million shares going across the tape as it moves up. Those are institutions, and so you have to think in those terms. I'm wondering where are the smart institutions going, what is obvious to the crowd, what isn't obvious to the crowd, and you'll see that there are a lot of stocks where you look at the fundamentals and you wonder what the heck is going on there, but somebody sees something there, and there are institutions betting their own dollars on those situations. So for example, something in real time is this TripAdvisor, 0% earnings growth in this last earnings report, which is to me pathetic, but the thing gaps up. Is this viable? I don't know. But somebody was coming in on this offering and buying it in here, and then the gap up, somebody's buying. I don't know if those are shorts or what, but this one I'm not so my thinking is, you want to mess with this, why not just buy Priceline? You know, it's the leader in the space. Why not just go with the big one? If this guy is doing so great, then so should Priceline. It should be doing better. So and I don't really see how 0% earnings growth makes the stock attractive in this case. But you know, there are reasons for making exceptions. But you know, how much weight do we put on it? There's really not this concept of weighing things. I don't really get into. Dr. K, do you place some weight in your mind on ROE and SMR and profitability, which is important to see, but is there a weighting, you know, like 5
Yeah,
pounds,
I mean,
10 pounds? I
it's
don't know.
contextual though. That's the problem with weighting. When you assign an absolute number to something, that means you're moving out of context because sometimes those numbers are going to be more important than at other times. And I think that's where, I mean, you know, O'Neill does all these model book studies, and you know, I spearheaded the 1998 project, and it's great. You know, we've analyzed every variable under the sun, assign weightings, you know, it's just, you get a very good sense of how stocks perform during that cycle. But if you can't stick with those weightings for other cycles, cycles are different. Every single cycle is going to be slightly different. So these weightings have to be flexible with the market environment. And so when someone says how important is ROE, or pre-tax margin, it depends on the sector, depends on the stock, the industry group. That all weighs into it in terms of where a high level of ROE is important, and relative to things like earnings and sales and the overall technical pattern. You know, where does ROE stand? And again, it's all relative to all those variables, and that's where it gets quite complicated. And I think that's where most people just sort of, you know, they stop their analysis because. Or they just use a shortcut of using weighting and black boxes, which, you know, black boxes have a limited life expectancy because they're too fixed.
Yeah. Somebody asked about MNST. I'll let you go off on this one, Dr. K. All I know is if I were long this stock on this day, I would have been selling into that move because you know, Cinderella comes once, and I don't know if Coca-Cola needs to buy Monster Beverage. Nice rumor. Thank you, Wall Street Journal. If you were long it, you know, I think you had to be selling it. Dr. K, your thoughts?
Yeah, it was. I remember seeing the price action intraday and thought, if I own this, I would be monitoring it like a hawk and wait for any kind of intraday weakness and dump it because it is still a rumor. A lot of things can go wrong with the deal. It's not a done deal. So I would have definitely taken the money at some point. Probably, you know, when it crossed back down below 80, I probably would have been out of the position. Now, if you sat through the whole thing, that is not a reversal. A downside high volume reversal, simply because that reversal was caused by a rumor. So you could just pretty much ignore that day, ignore that high volume day, and just treat the stock as if it never happened. The stock is still a leading stock in its space, and it looks like it's going to be heading higher from here.
It looks like it wants to, yeah. And you know, you could almost say this is a pocket pivot off the 10-day moving average because you could just discount this day as not really even existing. But I don't know. Maybe these are the but this is the bottom line. Notice how it's holding the 65-day exponential magic moving average. Look at that. But in any case, you know, somebody's saying, would you wait for it to bounce now? I don't know what to tell you because if I was in it, I would have been dumping it right away. I'd no questions asked, you know. If it finds support, then you can come back into it, you know, and that's a little bit what happened to me on the STX. Is like, you know, I'm in the thing, it gaps down and starts to flutter around, and I'm gone, and then I wait and see what happens. Then it gets support, big volume, you can come right back in, you know. But a lot of people won't come and buy a stock back, you know, if it's 50 cents higher from where they sold it, which I think is silly. But you know, I think when you have those types of high volume gap downs, if you don't act quickly, you risk getting your head ripped off. And so I just get rid of them. If they hold support and they come back up, you know, then like this, then I'll come back and buy them. But the whole idea, again, with any stock is not whether you get it 50 cents higher or lower from where it's trading right now. It's where it goes from where you buy it. So you know, if it's going to double, then you want to own that stock. If you're buying it because you're worried about 1 or 2 point wiggles, forget it. And if you're selling it because you're worried it might bounce from where you're, you know, selling it, well, it might. If it does, like in this case, it gets support, then you can come right back in and buy it if you want to. But you don't. I definitely wouldn't sit there like a deer in headlights and just say,
yeah, I mean, on UB and
chop
T,
my
I mean,
head off, now
you
chop
know
off
that
my legs, now
you
chop
know
off
that
my
it was they were going to report earnings the next day. We made an announcement. So, and of course, with earnings, there's going to be more volatility. But with any of your stocks, you should always have alerts set on each of your names so that if they get hit, you can take action. Now, if you can't watch your stocks during the day, then you might want to have actual hard stops set with your brokerage, so that if those prices are triggered, you're out of the position. So for UBNT, if you couldn't watch your stock, then at least put in a sell stop, somewhere where you might want to be out of the position. A pretty loose sell stop. Maybe 31 and change, because that if it goes all the way back down to that level, that means it's back in the base. Maybe 32, something like that. So you're not sitting in this position right now. If you are in the stock right now, my suggestion, if I had this stock, if someone said, here, we bequeath the stock to you right now, I would use yesterday's low of 20. I'd be selling this at 28.20. If it gets down to 28.20, that means it's violated the 50-day moving average, and I'm out of the position. It's not very far from where it's trading right now. It's possible it's going to have a volatility and bounce to the upside. And by the way, if it does bounce to the upside, let's say it doesn't trigger that yesterday's low at 28.20, I would be selling it probably if it gets back up into 31, 32 area. In other words, on a bounce, on a V-type bounce, very susceptible to further downside after that bounce.
Okay, let's go through some stuff. Somebody's asking about Nokia. Not on my radar screen for a long-term investment. I think you're way off track here. Here's a stock that gapped down, on heavy volume, and what do you think it's going to do? Suddenly turn around and go up? I think you need to go and read Bill O'Neill's book, How to Make Money in Stocks, because this is not how you make money in stocks. This is junk, and Nokia is a has-been company. And the stock reflects it. Maybe you get a bounce, but there's no, it's absolutely foolish to think that you're going to buy this stock for a long-term investment, and just because it's trading for $3.50, it has to go higher. I recall it was in 2001 or 2, whenever Enron went belly up and the stock traded down to $3, and they were interviewing a guy in Texas who had just won the lotto, and they said, what are you going to do with the money? And he says, I'm putting it all into Enron stock at $3. Lovely. So, I think you're thinking that way. You need to have your head examined, first of all, but it also shows that you really don't understand how to invest properly. And so, I don't mean to jump all over you, but of course, as all of you know from these webinars, that's kind of my style. You idiot. Anyways.
No soup for you?
But come on, that's not the way to do it. So please don't do this. All you're doing is you're on the wrong track. This stock to me gapped down. It looks to me like it's going to $2 before it's heading to $4. That's just what it looks like to me. So okay. So sorry. Don't mean.
This is a textbook case of what not to do.
Don't mean to be mean, but I do have a teenage daughter now, so I've been getting truculent in my old age and cranky. Amazon. Dr. K doesn't like it. I do. No. I'm taking a line from the movie Wall Street. Analysts don't like it. I do. What stock was that, anyways? I forget. Bud Fox trying to sell Gordon Gekko on some stock. That's a dog with different fleas. But anyways, Amazon, I guess a Bible gap up, but it's kind of low in the pattern. The one thing I've been noticing is you got Red Hat acting well. You got Citrix acting well. They're hanging in bases, trying to hang out. Rax, F5 here, Rax. All these things are basing. You notice that? And I guess the whole network thing, the cloud networking thing is all pretty strong. And I think that's Amazon's big trump card, is that they're probably going to be the one that wins the whole cloud storage thingy because they're just so huge and they have massive scale. I've read a lot of articles on the whole concept. You can go to seekingalpha.com, and there's a lot of people arguing, debating the who are the winners going to be. And there are a lot of companies competing in various spaces, but also companies that are kind of in bed together. So Red Hat has this product. What is the name of that product? They bought out a company, and Facebook has people on their board. Citrix Systems has people on the board. So a lot of them are in bed, but Equix is another one. This is in the Internet Network Solutions. Not holding up. So, I guess Amazon is probably the big stock in all of that, and forget about the Kindles and books and whatnot, and focus on their cloud business, which is probably going to be the fastest growing part of the business going forward. And that's probably what makes it viable. But I think at this point, if you didn't buy the Bible Gap Up Day, you're not looking to buy it here, so you're looking for something else, if that's what you want to do. Dr. A, do you have any thoughts?
Well, yeah, Amazon, it's a $100 billion company, so it's got a lot of different operations that could potentially drag the price. In other words, I don't see this one being a sprinter anymore. It's turning into more like a Microsoft slowly but surely, or even a Google, which I think has seen the best of its days behind it in terms of price appreciation, price acceleration. So yeah, Amazon doesn't interest me at this point. I would like to see some serious price acceleration on Amazon before I would consider buying the stock.
Yeah. Anyways, let's see. Sorry, but I'm in the middle of something here. Okay. Some people are saying they can't borrow in InventSense, but I'm just checking to see if it is, in fact, borrowable. Let's see. No, you can't borrow it through Schwab either, so that's interesting. In any case, I guess you can't. It's hard to borrow, but that's good. You just be sure Netflix. All right, where were we? Some more questions. Talked about Amazon. Bill O'Neill talks about managing Netflix in Wednesday's paper. Oh, well, that was when it was a leading stock, so that's a historical. Blah, blah, blah. Does the O'Neill portfolio managers sit through 7 months of basing? All I know is I never did as an O'Neill portfolio manager. I don't talk to any of those guys, and neither does Dr. K. Okay, just so you guys know, I don't talk to Bill O'Neill. I haven't talked to Bill O'Neill since I left, mainly because I have no reason to talk to him. So, would you short soda? Well, it's a Head and Shoulders. It might be shortable here. You're breaking down, so you would short it here using the 32 level as your stop. But that's a downside breakout through a neckline. Looks potentially good because of the fact that you have this big, ugly Head and Shoulders. So, yeah, that's a good one. Whoever saw that, I can't see the asker's name. Let's see. Who is it? No. Anyways, is RNF showing positive action? It is not hitting my radar screen, so I'm guessing. Oh, that's at Rentec. Well, it had a gap up here. Is it a viable gap up? Maybe. I mean, it looks like it. But, the one I've really liked in this group is the CF, which now is reversing. So maybe that's telling you something about this market. So all I know right now is I'm short Netflix, and it's probably the best performing position I've had in a while in terms of a one-day move. Dr. K, you made me feel good. I just did what you talked about on MNST. Well, that's good. Sold out for 17% profit. No, I was the one who said to sell it, wasn't I? Anyways, it made a 17% profit on that day and then bought back the next day on the pocket pivot. That's cool. Right on. Good for you. I'm glad
Nice
somebody
one.
off. And I remember seeing that. We don't own it, and I'm telling Dr. Man, I sure hope there's some people from the website out there in this stock and dumping this. And it's not like we're going to tell you to dump it. Continental Resources disappointing today on an earnings thing, and again, this is earnings roulette. Pioneer Resources was doing a little better, but these things are starting to reverse, and a lot of these stocks were the ones that were driving the S&P higher on that follow through last week, and it's why I think you have to be careful and not overextend yourself on the long side here, or think that you need to be buying heavily because you had an S&P 500 follow through last week. Again, take it on a stock-by-stock basis and operate freely where you have a cushion in terms of whether you're going to add or not. So people are talking about COP. What is COP? ConocoPhillips. These are dogs. If that thing isn't barking, I don't know. What is it? HLF. Somebody asked about it. I mean, here's an example of what happens, after earnings. But look at that. That's just a blow it. Is it shortable? I would look at this more on the basis of, let's see, where's the weekly chart? It's somewhere. Here we go. Here's a stock. You can see these as your left shoulders. Now, this is going to be your head. You're undercutting all these lows, so what I would now look for is a right shoulder to form, and then it becomes shortable. But definitely this break off the peak, this is a late stage, it's really not a late stage failed base. It's just a failed base. So I don't think you can short necessarily on that basis, and it's way down there. But I think at this point, you're undercutting these lows. This would be a logical area from which we might expect the stock to build some right shoulders. But I would put it on my short sale watch list and let it do what it's going to do. It may take some time. Like for instance, you look at the soda, it blows up. It may do something like this. See how it comes down and it undercuts the low of this base here, and then you get a rally back up and you start making right shoulders that you can try to short it into, but it makes a couple of them before really starting to come apart here. Today it looks like it's starting to really break down. You're probably headed for these lows. But if we take this example and look at HLF, okay, all that's doing is a first break. So you are undercutting this area. So like soda, we might expect at some point in here it's going to form some shoulders and probably come up into the 50 area. You might hit it there for a move down, but it may take several right shoulders before it really starts to come off. Okay, so I don't know if it's really short, but it definitely should be on your short sale watch list. David Einhorn's questions on the call. Yeah, I think he's a pretty smart guy. And for those of you who remember when we played Green Mountain Coffee last year, as it broke down here, we were shorting into this rally, and then a day later or so, we had the wonderful, wonderful David Einhorn come out and make some points about how crummy the company is, and the thing just blew apart, and that was a great short sale. Dr. K, what is your D-Day count?
I think we were at something like there was a whole cluster of these on the NASDAQ prior to April 20th, and since then the market's stabilized. So, you know, back April 20th we had a cluster, I think, of six of these things, and right now if you go back over your 20 days, you know, I'm not counting distribution days when the model's on a buy until I see other factors that, you know, material selling pressure, in other words. And right now, I mean, we've got, you know, like I said, the last 2 weeks has been all free and clear. You know, April 19th, April 18th, April 16th, April 15th, or rather 13th. Those are all distribution days. So you have 4 there, right, and then you have 5. So yeah, you know, you have a nice little cluster there. But you know, QE is still a very important factor here. So it's important not to let a cluster of distribution days scare you out of your positions on the long side, or in the case of the model, pushing it into a premature sell signal.
Okay. What was your target for Netflix? I guess, my Netflix target, as I was telling you, I'm looking forward to test this low. So it may bounce a little bit on the way down, but to me it looks like this thing is done, and everybody knows it, and it's just a matter of too many people trying to get out of the exit door all at once right now, and it seems to be building. You can see I'm watching this. One of the things I will look for, you know, on an hourly chart, you're seeing boom, 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 straight down. Each bar is pretty much equivalent to the next one. At some point, you're going to see on the 5-minute bar, you're going to see a long bar to the downside, I would imagine, because that'll be probably a capitulation low short term. So if I'm running a big position, say 200, 300, or 400%, you know, just loading the boat here, then I would probably look to cut part of the position, drop down somewhere to a core, maybe, you know, half of what I had. I don't know. This one looks pretty weak, but you're seeing now some capitulation. Or somebody gets in there, and you can see it comes out in some volume and tries to hold briefly, and then it rolls lower on the 5-minute. So, you know, I've just been holding it short all day and hitting it real heavy right on the opening, coming in with a core position, and it broke down. And my premise was somebody saying it takes cojones to short Green Mountain Coffee on the opening. Actually, not really. I think you could have shorted Green Mountain on the opening. Let's go to a daily chart, and you'd probably just use the high of the day as your stop. It's kind of a Bible gap up in reverse, and I think those do work. So I think, you know, but the other thing was, my premise was, if Green Mountain is coming down, Netflix is in a similar type of position as I showed earlier, and I think it's also in a similar position with respect to its business. The margins are coming out of it. It's just being commoditized, and so I think the stock's heading to 60. I don't know if it bounces between here and there and how many times. All I know is that was how I played the Green Mountain short rather than going after Green Mountain, but I think you probably could have. But we're looking for somewhere around 60 ultimately. Doesn't mean I won't cover my position either all or part as it bounces or reaches what I think are kind of capitulation lows in the interim. So somebody wants to know about INVN. Okay, let's take a poll. Somebody says here, I logged in late. Can you give the short version on INVN? Should we let latecomers come in and influence the discussion like that? I mean, all you other people who got here earlier, what do you think? Blow them off or answer the question? Probably in the time.
Do it pretty quickly, or they could reel back the tape, you know.
Oh, I love it. I love that. That was great. Latecomers suck. No. blow them off, wait for the video. One person said yes. Now that's a charitable person. Look, I'm going to go through this in 2 seconds. INVN, as I've been telling you guys before, if you've been on these calls before, left shoulder head, right shoulder, and I told you when it was down in here, I'd look for a right shoulder to the form, which means it'll rally into the 50-day moving average. Is it a short there? You can't borrow the stock, so it isn't a short, even if you wanted to. So I wouldn't be buying it. If I could borrow it, I might be shorting it, but I'd rather wait to see what it does after earnings and just stay short Netflix, okay? All right. There are some people say, yes, Gil, be nice. Okay. It's like rolling back the tape so he can get in at a lower price. No, not really. Well, I don't know. Anyways, why not sell calls on INVN? I wouldn't sell calls. I'd buy puts if I was going to play options, because I think sell calls and you could get tagged, I think. I don't know. I'm not really a big options player. So anyways, don't be nice. Be real. Okay, I'm being real. No soup for you. Anyways, what else do we want to talk about? That seems to be all the questions we have now. It is 9:29 a.m., exactly 1 minute before 1 hour into this. I think we started maybe a couple minutes late. But anything else you're seeing here, Dr. K? Anything notable? Nope, just kind of watch and see what happens. You got the jobs number tomorrow. Just watch your stocks. You know, if they're acting well, you know, and you were able to pick up something like this as opposed to something like this. Oh my God, that's really ugly. I'm almost want to short that one. That's so ugly you want to short it, but I think I'll refrain. And you know, one of the things you want to watch out for, you'll get excited if you get one stock right on the short side. You'll get excited and you want to start shorting everything that looks halfway ugly. Just stick with the one that's working for you and focus on that one. That's what I would say. So, but I'm looking at this thing still is not forming a low either on the 5-minute and on the 60-minute. Don't really see it yet. So anyway, so we're hanging. Anyways, that discussion will only be for the webinoids for all of you guys. I haven't put that up on the website because I'm keeping it to myself. Sorry. Some of you could have come in and hit it earlier when we started the webinar an hour ago. You'd be up a couple, $3 here. So you know, you guys could have played it. I guess it's still probably playable. The only risk is you do have a potential for snapback up towards 80, I think. But I don't know. That's probably dependent on whether Netflix has some kind of a rumor. But it is a very weak stock in an otherwise choppy market. My take is the action is inconclusive. We have a buy signal in the market direction model, so you can go at that if you are a person who implements the market direction model. Otherwise, my recommendation is to play the market as a market of stocks, not as a stock market, and be open to ideas on either side without becoming bullish or bearish yourself. You know, there's no reason to have to take a stance. Just look at the stock, assess the trade, and take your shot, and that's basically how we do it.
Yeah,
Somebody wants me to comment on
actually doing a I use a hybrid approach. I right now in my account, for instance, I've got an ETF from based on the MDM model, and I also you know, I hold a stock because it is a market of stocks. In fact, I would argue that it's always a market of stocks, and so you know, always be running your screens and look, you know, be on the lookout, get our reports, and then make your decision on which stocks you might want to own, regardless of market direction, because we do certainly take market direction into account. If the market is in a tailspin to the downside, it's very unlikely we're going to send out any reports on pocket pivots or viable gap ups. It's very unlikely. It's not out of the question, but unlikely. And also one final comment on the TVIX UVXY model. You'll notice that the market is off almost 1% here on the NASDAQ, and down over 1% on the Russell 2000, and yet UVXY and TVIX are about flat. They're trading about flat, and these are very volatile instruments that typically will go up several percent in a day, if not more, or down several percent. So there's a tendency for these instruments to go lower during markets that are, say, quietly selling off or quietly being trendless. So it has two types of market environments where these things can go lower. So if you're on the short side, you're going to be profitable, and that is trendless markets and upward trending markets. So it's kind of interesting to see this in action. And of course, this study is a work in progress. I want to keep reminding everyone, but so far the results are looking fairly promising.
Okay. I'm still long the UVXY, just so you know, Dr. K.
That's fine. Well, you've got a different time horizon, and I would say that if something you find something that works, then let's add a third timing model for those quick shoot from the hip type of traders.
Right. Okay. Just some quick. What's this? Gil, give us a quick opinion on PMs. Just wait and watch. They have moved down quite a bit. We tend to think that the metals are just in big basing patterns, and they're going to move back and forth within those patterns. I think I'm a buyer of physical gold under 1,500. If I saw it at 1,400, I probably would step up myself and add to my physical holdings, which I purchased around 280, between 280 and 320, and then again at around 830. So I haven't added any physical gold since then, but I think I would buy on a pullback under 1,500. That depends on how that occurs, when and if it occurs. But for now, all we do is see these things in big sideways movements, waiting for the next buy signal. Somebody says, I'm glad I can make you all have a good laugh even at my expense. We're not laughing at you, we're laughing with you, hopefully. So, but all in good fun, you guys. We're just here to have fun. Don't take it all too seriously. And, we like to talk about stupid things we did. I mean, I told you guys about how we got hacked up in InventSense. So, it happens to everybody. So let's all laugh at ourselves. Anyway, somebody asked about CAT as a short. I'm not shorting it here. So up in the 50-day, if you guys remember, I was talking about it up in here. CMI was another one. They rally, they break down, and then they rally right in the 50-day. That's where you got to be looking at them. I'm not so sure I want to be short them here. So VPHM, I think that's an obvious dog, and you don't want to be buying it. And certainly we haven't liked it since it broke down here very sharply, and so we really haven't talked about it. And definitely, if you weren't out of it here, then you should have definitely been out of it there. If you bought it anywhere in here and you're still in it, then you were guilty of really not paying attention to your position. Michael Kors, you had a pocket pivot 2 days ago, but this is coming off the bottom, and you're running into resistance. Earnings come out, I think, in the middle of May. Sometime, and so you would expect to pull back to the 50-day if you want to buy it into earnings. Okay.
Yeah, I think we said in the report that it had a pocket pivot, but it's a cautionary one, so simply because it's a straight up off the bottom type of move, so it's entitled to pulling back before moving higher.
Yeah, and Cerner is another one. That's a nice move. If you're looking to buy it, you definitely have to wait for a pullback. LinkedIn, I guess we'll finish off with LinkedIn. LinkedIn coming out with earnings after the close. If you want to buy into the earnings, I don't think you have to. As I was talking about at the beginning of this webinar, the stock has really just built this big old hairy-looking base thing since it came public last year, middle of last year, and it hasn't broken out to the peak, which is somewhere around 120 and change. And so I think you might look for some kind of a breakout on earnings that tells you this is when the stock is starting to move. Otherwise, if you take a position in the earnings, you have to figure if the stock busts 20% from here and you have a 10% position, then that's going to cost you overall to your portfolio 2% and kind of thing in those terms. Myself, today I've got a good trade going on in Netflix. I'm making pretty big money, actually, on that. Myself, so I don't really see any reason to muck it up trying to play LinkedIn into earnings myself. So anyways, we already talked about Rax, holding tight with the rest of the networkers. So anyways, that's all we got. It's been an hour and 7 minutes, and that's kind of where you're at. Play it as marketed stocks, which Dr. K says you should always be doing anyways, and reacting to what your stocks are doing, not so much what the indexes are doing, and I agree with him on that wholeheartedly. And I talked about Google as a potential short sale target coming up into the 50-day or even up into this area of resistance, which looks to me like it's around 614, 615. Am I right there? Let's see. No, higher than that, like 618, 615 to 618 it looks like in here. So I think anywhere in here, this might be a short with the objective short term to be the 200-day, and maybe it goes through it if the market gets weak. But you got to kind of watch where the market is, okay? Anyways, that's it, you guys. Thanks for watching. If you have any other questions, please email us. Also remember that you can email us questions specifically for the webinar for us to cover beforehand. And that's easier because I make a list of everything that people email us on, so we make sure we discuss that first, and then we move on to the questions. So if you have something that we haven't answered, or you have something in mind that you think is important for the next webinar, which I'm guessing will be next week, unless something big happens tomorrow that we have to comment on. But I think you're talking about next week. So if you have anything you want us to discuss, email us, and we'll definitely make sure to get to it. All right. All right. Anyways, that's all I've got. Thanks, everybody. We'll catch you next time.
So long, everyone.